Welcome to the deep dive. Today we're tackling something really fundamental. Why we do what we do with our money.
Yeah, those decisions we make.
Exactly. We'll be pulling apart some real-world examples, looking at research, trying to get under the skin of our financial choices, especially those ones that sometimes leave us scratching our heads. Our goal, really just to shine a light on maybe the hidden emotional currents, the biases that sort of steer our financial ships.
And our main guide for this, our compass, if you like, is Morgan Housel's book, The Psychology of Money.
Great book.
It really is. Think of it as, well, a treasure trove of stories, a bit of historical context, and some really eye-opening research. Helps us understand everything from, why we chase riches to what actually brings us financial contentment.
And I think a crucial starting point, something for you, the listener, to really consider right now, is that your relationship with money, it's unlike anyone else's.
Completely unique.
It's been uniquely shaped by the life you've lived, right? The specific moments, the experiences you've had. And these become the sort of bedrock of your financial beliefs. They mold your goals. And, well, ultimately, they color how you see the entire financial world.
Yeah.
Okay, so let's unpack this. Let's start with maybe a surprising idea. Smarts don't always equal financial success.
It's fascinating, isn't it? This idea that navigating money effectively often comes down more to how you behave than, say, how many degrees you have on the wall. You can be, I don't know, a rocket scientist and still make some truly baffling financial decisions.
Oh, yeah. Seen it happen.
And conversely, someone with maybe a more modest academic background, they can build significant wealth just through consistent, sensible habits.
Well, consider this story Housel tells. There's this highly successful executive, clearly an intelligent person. Right. But he had this habit of incredibly impulsive spending. Like dropping a fortune on a broken lamp, just on a whim.
Wow.
And ultimately, this behavior, well, it led to his financial ruin. Now, here's where it gets really interesting. You contrast that with Ronald Read. Remember him? The janitor and gas station attendant.
Yes, the janitor millionaire.
Exactly. Humble background, apparently hitchhiked to school.
Yeah.
Yet, through decades of just quiet, consistent investing, he built a surprisingly large fortune, enough to leave millions to charity when he passed.
That contrast, it's so stark. It really highlights a key takeaway, doesn't it?
It does.
These behavioral skills that are crucial for financial well-being, things like emotional control, patience, really understanding your own risk tolerance. They're often the unsung heroes.
Totally.
They frequently outweigh pure analytical horsepower, in the long run.
Okay, so let's shift a bit. Our next area explores how deeply our personal history, our individual perspective, influences our financial psychology.
Yeah, this is interesting because we often think of money as this, I don't know, objective thing governed by rules as firm as physics, maybe.
Like there's a right answer.
Exactly. But when you dig deeper, our interaction with money, it's far more like psychology. It's messy, it's emotional, highly individual. What one person sees as a perfectly logical financial move, another might view as completely irrational.
Right.
And that often just boils down to their unique life experiences.
Think about, say, someone who grew up during a time of real scarcity.
Yeah.
How might they view debt compared to someone who's always known financial security?
Totally different perspective.
Or consider the lasting impact of experiencing runaway inflation early in your life versus, decades of stable prices. These kinds of events, they leave a real mark.
They really do, and it raises an important question, I think. How can we truly understand why someone makes a particular financial choice without knowing the sort of economic and historical backdrop against which their views were formed?
Yeah, context is everything.
Take the Great Depression, for example. It instilled a level of financial caution in an entire generation that might seem, well, overly conservative to those of us who haven't lived through similar hardship.
And it's not just stories, right? There's actual research here.
Oh, yeah. Researchers like Ulrich Malmendier and Stefan Nagel, they looked at decades of consumer finance data.
And what did they find?
A really strong link between an individual investor's willingness to take risks and their personal history, specifically the economic conditions they experienced during their formative years.
So it's not just about what you know intellectually.
No, it's about what you've lived through. It shakes you.
It reminds me of that quote from Michael Batnick.
Oh, yeah. Some lessons have to be experienced before they can be understood.
Exactly that one. You could read all the books you want, but the emotional impact of, actually living through a market crash or seeing hyperinflation,
Yeah.
That shapes us in really profound ways.
Absolutely.
Okay, let's shift gears slightly. Let's talk about the illusion of control we sometimes feel over our financial lives, and maybe why understanding what motivates other people is so crucial.
Well, what's fascinating is that our financial decisions, they aren't made in some kind of spreadsheet vacuum, are they?
No, definitely not.
They happen in the real world. They're influenced by our personal history, like we just discussed, but also our egos, the constant barrage of marketing,
Oh, the
and
marketing.
all sorts of hidden incentives that kind of shape our thinking in the moment.
Housel uses this example that seems, well, a bit of a head scratcher at first. Why do people with low incomes often buy lottery tickets?
Right. From a purely rational standpoint, spending money on something with such incredibly low odds, especially when you're struggling financially, it seems completely illogical.
It does.
But if we try to understand the underlying desire, maybe it starts to make a bit more sense.
How so?
Well, for someone facing maybe limited opportunities, a seemingly insurmountable climb towards a better life, that lottery ticket, it can represent the only tangible glimmer of hope.
Ah, okay. The dream.
Exactly. The only real chance, maybe, to dream of a different future. They're not just buying a ticket, they're buying the possibility of a different narrative for their life.
So it's about understanding that even seemingly irrational behavior often have these underlying motivations rooted in people's experiences and circumstances,
Precisely.
which kind of leads us to consider something we often just take for granted, how relatively recent many of our modern financial concepts actually are.
That's so true. It's easy to assume that the idea of, widespread retirement and that each of us is personally responsible for funding it, that it's always been the way things are.
Yeah, it feels normal now.
But the truth is, this is a surprisingly recent development. It largely took shape after World War II.
Think back. Before World War II, what was the norm for most people?
Pretty much just working until you physically couldn't anymore.
Right. The idea of having decades of retirement funded by your own savings,
Yeah.
that just wasn't the standard expectation. Even Social Security, when it first came in, wasn't designed to be a comfortable retirement income on its own.
Not at all. And this notion that private pensions were this really widespread thing in the past, that's actually a bit of a myth. Yeah. Research shows that even as late as the mid-1970s, only a minority of folks over 65 received income from private pensions.
Wow. Okay.
And the key retirement savings tools we rely on today, things like the 401k.
Established 1978,
Yep, and the Roth IRA.
1998.
They're incredibly recent additions to the financial landscape.
That historical context, it really highlights just how much the world of personal finance has shifted, how new this concept of individual retirement responsibility truly is.
It's a massive shift in a relatively short time.
Okay, now let's delve into something often underappreciated: the roles of luck and risk in shaping our financial outcomes.
Yeah, it's fascinating how quick we are to attribute financial outcomes solely to skill, oh, they're brilliant, or solely to someone's mistakes, they messed up.
We love simple narratives.
We do, and we often overlook the significant part that both good and bad luck and just the inherent risks involved play in the whole equation. For every story of incredible financial achievement, there are likely many others with similar talents, similar drive, who experienced very different outcomes simply due to factors beyond their control.
Housel uses the stories of Bill Gates and Kent Evans, right? Both described as incredibly bright, motivated,
Yeah, very similar starts in many ways.
yet their life paths, their ultimate successes were dramatically different. It just illustrates the impact of those unpredictable moments, those chance encounters.
And attributing all success only to skill can breed overconfidence, right?
Dangerous.
While blaming all failures only on bad decisions can be really disheartening and ignores the inherent uncertainty in the financial world.
So true.
I mean, even legendary investors like Benjamin Graham, Warren Buffett's mentor, a significant portion of his partnership success came from a single, remarkably lucky investment in Geico.
And didn't that actually go against his own rules?
It did. It went against his own strict rules on diversification. It was a huge, concentrated bet that paid off massively, mostly luck.
So the big takeaway here is, when we look at financial success, both our own and others, it's just vital to acknowledge the influence of luck and risk.
Yeah, be humble about it.
We should probably focus more on understanding broad patterns of success and failure, rather than trying to perfectly copy the strategies of extreme outliers, where luck is almost always a huge factor.
Exactly. Focus on the principles, not the specific lottery ticket.
Which actually brings us nicely to a concept that might seem a bit counterintuitive at first, knowing when you have enough.
Ah, yes. The elusive enough.
It really is. Understanding when you've reached a point where maybe accumulating more money isn't worth the added risk, especially the risk of losing what you already have and need.
Mm.
That's a crucial but often ignored financial skill.
It really is. And if we connect this to just a broader life perspective, there's that anecdote about Kurt Vonnegut and Joseph Heller, right?
Oh yeah, love that one.
They were at a party hosted by a billionaire, and Vonnegut points out that the billionaire made more money that day than Heller had made from his novel Catch-22 in its entire history.
And Heller's reply.
Heller says, yes, but I have something he will never have. Vonnegut asks what, and Heller replies, enough.
Oof. It's home. There's a point where more money doesn't necessarily translate to more happiness or security.
Absolutely. And history is just full of cautionary tales here. You think about Rajat Gupta.
Former head of McKinsey, board of Goldman Sachs.
Yeah, highly successful. Or the collapse of long-term capital management with Nobel laureates on board.
Right.
These were individuals and firms who risked what they had and needed in pursuit of even more wealth, what they didn't need, ultimately leading to their downfall.
So the really difficult financial skill, as Housel puts it,
is getting the goalpost to stop moving, getting your definition of enough to stay put.
because there are certain things, your reputation, your freedom, family, love, happiness.
The important stuff.
Yeah, the important stuff. It's simply never worth risking, no matter the potential financial reward. Okay, let's switch gears again. Let's talk about the seemingly slow, but ultimately incredibly powerful force of compounding, and why thinking long-term is so critical in finance.
I love the analogy Housel draws here. He compares it to the formation of ice ages.
Ice ages? How so?
Well, they happen through incredibly small, almost imperceptible changes, tiny shifts in temperature, accumulating snow over vast stretches of time.
Okay.
And that's like the extraordinary results that can come from the consistent compounding of even modest returns over very long periods in the financial world. It's slow, then sudden.
Warren Buffett's story is the classic example, isn't it?
Absolutely perfect example. While he's undoubtedly a brilliant investor,
Without question.
the sheer scale of his wealth is largely due to the fact that he started investing so early in life and has just consistently stuck with it for decades upon decades.
The difference in his net worth, if he had started, say, just 10 years later,
Yeah.
it's staggering.
It's mind-boggling, and when you compare him to someone like Jim Simons at Renaissance Technologies,
Whose fund has achieved significantly higher average annual returns.
retiree returns, yeah. Yet Simons' total wealth is less than Buffett's. Why? Because Buffett has been compounding for much, much longer.
Time is the magic ingredient.
It really is. It highlights our tendency, I think, to think linearly, step by step rather than exponentially. It makes it hard to intuitively grasp the truly transformative power of long-term compounding.
This leads us naturally to a really important distinction, I think.
Wow.
The difference between getting wealthy and staying wealthy.
Oh, that's a big one. Very different skills involved.
If we look at some historical examples like Jesse Livermore.
The legendary speculator made and lost fortunes multiple times.
Right. And Abraham Germansky wiped out in the 1929 crash after making a fortune. These stories illustrate a crucial point: the mindset, the skills needed to accumulate wealth. They aren't necessarily the same ones you need to hold on to it for the long haul.
Totally different. Getting wealthy might involve taking risks, being optimistic, maybe aggressive. Staying wealthy requires a degree of paranoia, frugality, fear.
So, Housel boils down the key to long-term financial success to just one word:
Survival.
survival. He points out that a surprisingly large percentage of even successful public companies eventually lose most of their value.
Yeah, the graveyard of business is vast.
It emphasizes the importance of simply staying in the game over the long term.
Michael Moritz from Sequoia Capital, the venture capital firm, he echoes this. He said something like, a constant fear of going out of business has actually been a key to their long-term success.
Interesting perspective for such a successful firm.
It is. Because compounding isn't just about hitting home runs every single year. It's about consistent, uninterrupted growth over decades.
Which means you have to be able to weather the inevitable ups and downs.
Exactly. You have to survive the downturns. Having cash on hand, for instance, gives you that flexibility. It means you avoid having to sell assets at the worst possible times, locking in losses.
Survival. Okay. Our next point looks at something we all grapple with: the fact that even the best laid plans, well, they often go awry, and why we need to build in some wiggle room.
Yeah, planning is essential, right? You need a map. But what's fascinating here is recognizing and accepting that things rarely go exactly according to that map.
Oh, tell me about it. Life happens.
Exactly. The last few decades alone have thrown us curveball after curveball: market crashes, pandemics, unexpected inflation.
So a robust financial plan isn't one that assumes perfect foresight?
No, definitely not. It's one that builds in a margin of safety.
Margin of safety. What does that mean in practice?
Well, it could mean extra room in your savings, right? Maybe more conservative investment projections than you strictly need, having financial buffers like emergency funds, just general wiggle room
The goal being.
to be able to absorb unexpected setbacks without completely derailing your long-term goals. You can bend, but you don't break.
And this idea of a margin of safety, it also relates to how long-term progress actually works, doesn't it? It's
Yeah.
not usually a straight line up.
Not at all. It often involves short-term volatility, setbacks, even periods that feel like destruction or going backwards. In the investment world, for example, it's actually not uncommon for even really successful long-term investors to be wrong a significant portion of the time on individual bets.
But they still come out ahead. How?
Because a small number of what are called tail events, those rare outlier occurrences, the big winners often drive a disproportionate share of the total outcomes.
So a few big successes outweigh many small failures or mediocre results.
Exactly. Most companies are average or fail. A few are extraordinary winners and pull the average way up. So the ability to stay calm, stick to your plan, do the average thing when everyone else is panicking, that becomes a critical skill in navigating these volatile periods and capturing those tail events.
Like Sue in Housel's example, who just kept investing steadily through thick and thin, versus Jim and Tom, who tried to time the market during recessions.
Perfect illustration. Sue won just by surviving and staying consistent.
This leads us to think about the often personal cost of financial success.
Yeah, if we connect this to our own experiences, achieving financial goals, like most worthwhile things in life, it comes with a price tag. And it isn't just measured in dollars and cents.
What kind of price?
Well, that price can include periods of volatility in your investments, the fear of losing money, the doubt that creeps in during market downturns, just the general uncertainty about the future, even the regret of missed opportunities.
The emotional toll.
Exactly. And trying to avoid paying this inherent price often leads to worse long-term outcomes.
How so? Can you give an example?
Sure, think about the intense pressure on public companies to constantly meet or exceed quarterly earnings expectations.
Right. The short-term focus.
Yeah. Sometimes that leads to short-sighted decisions, or even in some cases, outright manipulation like GE was accused of. They were trying to avoid the appearance of volatility, the price of honest reporting.
Or think about speculative bubbles.
Good one. Driven by the desire for quick riches, FOMO. Even when underlying valuations seem completely unsustainable, people jump in trying to get the reward without accepting the real risk.
So the key is to recognize that these uncomfortable feelings, the fear, the doubt, the volatility, they're often just part of the process.
Pretty much. They're the fee you pay for potential long-term returns. Trying to get the returns without accepting the potential downsides is like, I don't know, trying to get fit without ever breaking a sweat. It rarely works out well in the long run.
Okay, now let's explore something interesting. The often powerful, sometimes misleading influence of pessimism and why we seem to underestimate how much things can actually improve over time.
It is fascinating, isn't it? Pessimistic viewpoints often sound more sophisticated, somehow smarter.
Yeah, the cynic always sounds intelligent.
Right. They tend to grab our attention more readily than optimistic ones. There's this intellectual allure, maybe, to pointing out potential problems, while optimism can sometimes be dismissed as naive or unrealistic.
But true optimism, as Hills describes it, isn't about blindly believing everything will be fantastic, is it?
No, not at all. It's more of a grounded belief that, despite inevitable bumps and setbacks along the road, the odds of things generally getting better over the long term are in your favor.
Just based on.
Well, the simple fact that most people wake up each day trying to make things a little bit better, solve problems, innovate, that's a powerful, though often overlooked, engine of progress.
So why does pessimism tend to be so persuasive then?
There are probably several reasons. One, money is something that affects everyone, so bad financial news resonates really widely. Two, bad news often feels immediate and urgent. A market crash happens quickly. Progress, on the other hand, tends to be more gradual, slower, less immediately noticeable day to day.
Like watching grass grow versus watching a building burn down.
Exactly. We also have this tendency, I think, to underestimate the human capacity to adapt and solve problems. That can lead to a more static and therefore a more pessimistic view of the future.
And maybe economic downturns themselves.
Yeah.
They're not always just about tangible damage.
Right. They can be heavily influenced, sometimes even driven by just a loss of confidence, by negative narratives taking hold, even more than by purely economic factors. Pessimism can become a self-fulfilling prophecy sometimes.
Which brings us neatly to the profound impact of stories and the power of belief in shaping our financial realities.
Yeah, this connects directly. If we think about human nature in times of uncertainty or when the stakes feel really high, people are naturally more inclined to latch on to compelling stories.
Even if those stories aren't necessarily backed by solid evidence.
Especially then, perhaps? Think about, I don't know, historical medical practices that seem barbaric now, or how people react during dramatic market crashes, panic selling based on fear narratives.
Or even experienced investors getting swayed by a well-crafted narrative.
Absolutely. Look at huge Ponzi schemes, like Bernie Madoff's. He told a compelling story of consistent, low-risk returns that people desperately wanted to believe.
So our brains are wired for stories.
Essentially, yeah. We're storytelling machines. When we encounter something we don't understand or something that feels threatening, we look for explanations. And compelling narratives often fill that void, whether they're accurate or not.
Hustle uses that analogy of an alien observing Earth, right?
Yeah, it's insightful. Without understanding the underlying stories, the beliefs, the motivations that drive human behavior, why people save, why they spend, why they panic, just observing the external actions like market movements can be deeply misleading.
You can see the what, but not the why.
Exactly. And that's crucial to keep in mind when we're trying to understand financial markets or even just individual financial decisions.
Okay, so we've covered a lot of psychological ground here. After this deep dive, what are some concrete things, some practical takeaways that we can use to help us make better financial decisions?
Yeah, let's try and distill some key principles. First, I'd say really respect the role that both luck and risk play in financial outcomes. Don't get carried away by success or too down about setbacks.
Yeah, okay. Humility. What else?
Keep your ego in check. Housel says saving is essentially the gap between your ego and your income. That's a good one to remember.
Huh, yeah, like that.
Make saving a consistent habit. Even if you don't have a specific, immediate goal in mind for every dollar saved, that saved money provides crucial flexibility later on.
Right. Unexpected opportunities or problems.
Exactly. Also, understand and be ready to accept the real price of financial success, and remember that price often isn't monetary. It includes volatility, fear, doubt, uncertainty.
Accept the discomfort as part of the deal.
Pretty much. And prioritize having that margin of safety in your financial plans. Build in wiggle room that provides the resilience you need for long-term growth.
Okay, what else? Avoid extremes.
Definitely. Avoid making extreme financial decisions, going all in on one thing or trying to time markets perfectly. You might regret those later as your life and priorities inevitably change.
And recognize sunk costs.
Yes. Be willing to walk away from past financial decisions or investments that no longer serve you, even if it means admitting a mistake or taking a loss. Don't throw good money after bad just because of ego.
Understand the difference between rational and reasonable.
That's a subtle but important one. What looks perfectly rational on a spreadsheet might feel completely unreasonable given your own personal circumstances, risk tolerance, and emotions. Aim for reasonable.
Be careful about using the past to predict the future too precisely.
Yeah, be cautious of assuming that past financial data is a perfect predictor. The world is constantly evolving. Historians make terrible profits.
Got it. Remember that higher potential returns usually come with higher volatility.
Always. There's no free lunch. Be aware of the financial game you're actually playing, your time frame, your goals, your risk tolerance, and try hard not to get swayed by the actions and strategies of others who are playing a completely different game.
Good advice, especially with social media comparisons.
Absolutely. And finally, perhaps, be wary of extreme pessimism. Remember that progress often happens more steadily than disasters do, even if it doesn't grab the headlines.
Okay, that's a solid list. Let's shift our focus slightly for the last couple of points, looking more at the psychology of spending and what true wealth really means.
Yeah, this is interesting. There's a paradox Housel points out. We often pursue wealth thinking it will signal something positive about us to others, success, coolness, whatever.
Showing off the nice car or the big house.
Right. But often, other people simply register the wealth itself, the car, the house, and maybe use it as a benchmark for their own aspirations rather than actually admiring the person who owns it.
Huh. So the signal doesn't always land the way we intend.
Often doesn't. And true wealth, as Housel defines it, is often what you don't see.
Oh, so.
It's the unspent income. It's the financial assets that haven't been converted into flashy stuff yet. It's the financial reserves that provide security, independence, optionality. Wealth is the money you didn't spend.
That really reframes it. And it highlights the power of a high savings rate.
Hugely powerful, regardless of how much you earn. It's about finding contentment with what you have and actively working to prevent that lifestyle creep where your spending just automatically rises to meet your increasing income.
Keeping the goalposts from moving again.
Exactly. And the sense of control and flexibility that comes from having cash savings household calls it the oxygen of independence.
I like that phrase.
Me too. It's invaluable. It gives you the ability to navigate unexpected life events or seize opportunities without being forced into making financially compromising decisions, like selling stocks low or taking on bad debt.
And ultimately, sometimes this strictly rational financial path on paper might not be the one that leads to the greatest personal satisfaction or peace of mind.
That's right. Sometimes reasonable beats rational for your own happiness.
Okay, our final point to explore gives us some really crucial historical context. It looks at how the modern consumer society, the one we live in, was essentially created.
Yeah, this provides perspective if we look back to the period right after World War II.
Big economic boom starting.
Right. And there was a deliberate push, partly by government policy, partly by business, to stimulate consumer spending as a key driver of economic growth.
How do they do that?
Well, think low interest rates making borrowing cheap, the expansion of consumer credit mortgages, car loans, credit cards becoming more common. It was intentionally designed to encourage borrowing and spending.
And this coincided with a period of
Relatively high income equality compared to before the war or after the 1980s, the golden age, some call it. This helped create sort of shared expectations around lifestyle and consumption for many Americans. People saw their neighbors getting similar things.
Okay, so that was the mid-century picture.
Yeah.
But then things changed.
Yeah, the economic landscape shifted pretty significantly after the 1970s and into the 1980s and beyond. While overall economic growth continued, the benefits became increasingly concentrated at the top, leading to much greater income inequality.
But the cultural expectations didn't necessarily adjust.
Exactly. The expectations around lifestyle, what constituted a good life, fueled by media, advertising, and later the internet, those largely persisted, or even grew.
Even as incomes diverged.
Right. This created what's been called the big stretch. Many individuals and families started taking on significant debt, bigger mortgages, more credit card debt, trying to maintain or achieve a lifestyle comparable to that of a wealthier minority, even though their own incomes hadn't kept pace.
Keeping up with the Joneses, but the Joneses got way richer.
Kind of, yeah. So understanding these historical forces that have shaped our current financial landscape, our expectations about consumption, it's really important, I think, for reassessing our own spending habits and figuring out if those ingrained frameworks are truly serving our long-term well-being.
That makes a lot of sense.
Yeah.
So as we bring this deep dive into the psychology of money to a close, the central theme seems really clear.
What stands out to you?
Well, that our financial success, or lack thereof, is just deeply intertwined with our psychology and our behavior. It's not just about numbers.
Absolutely. It's shaped by our individual histories, like we talked about, our ability to manage our emotions, fear, greed, impatience.
Right, and having a clear understanding of that complex interplay of risk and luck and the critical importance of long-term thinking.
Couldn't agree more. Which leaves us perhaps with a final thought for you, the listener, to mull over.
Okay, let's hear it.
Considering these relatively recent historical shifts we just discussed in personal finance responsibility, in societal expectations around lifestyle and consumption, how are these factors still influencing your financial behavior today? Maybe subconsciously.
And the follow-up question.
Yeah, the big one. Are those deeply ingrained frameworks, those expectations maybe inherited from a different economic era, truly supporting your long-term well-being and happiness in today's, constantly evolving economic world?
Something to definitely think about.